So continuing with our practical examples, let's look at the operating cash flow of Alphabet, or what we like to call Google. Now Google in 2021 had a net income of $76 billion. Because the figures are in millions, is $76,033 million, that is around $76 billion. In this we add our non-cash expenses, depreciation, amortization, impairment of intangible assets. These are all non-cash expenses. These are basically journal entries put up in the income statement. So we add these back. Similarly with stock-based compensation expense, it is not expense in cash. You literally pay it with Google stock. So we add this back. Deferred income taxes, like I told you, it's basically a journal entry. So it's supposed to be added back. Then we basically deduct the gain on debt and equity securities. Why this? Because it is not an operating item. It is an investing item or a financing item, depending upon what kind of gain it was. Others, this is miscellaneous expense, which have basically been reduced from the cash flows. Then comes the working capital changes. So we have account receivable. It is reduced. What does this mean? It means that $9 billion of debtors or account receivables have increased during the year. Why? Because the cash flow is negative. That means that the account receivables have increased. Current assets have increased. They have reduced the income taxes paid on it. And we have other assets, the current assets. This has also reduced the cash flow. That means it has increased. Accounts payable, it has increased the cash flow. So that means that the accounts payable, that is current liabilities, have increased during the period. Same with accrued expenses, they have increased. So it has increased the cash flows, and you know the drill. So the net cash provided by operating activities is $91 billion. And as we have seen in our Amazon, the operating income or the net income was different, and the cash flow from operating is higher. It is almost higher by $15 billion. What is the reason for this? Well, the major reason for this is depreciation and stock-based expenses, which contributes to around $26 billion of expenses which are non-cash expenses. The other parts, which are basically the cash flows, the working capital, Google is not managing its working capital extremely efficiently. Why? Because Google, in effect, is not actually a manufacturing or a trading company like Amazon. It is more of a service-based company. So that is why its major cash flows from operatings, the major differences are coming from depreciation and the stock-based compensations.